In July of 1980, the S&P 500 earnings yield was 7% higher than the yield on a 3-month Treasury bond, so stocks were very attractive. This helped drive a significant rally in the stock market. It rose 43% in just over a year, but then things flipped around. Inflation was out of control, reaching nearly 15%. This prompted the Fed to hike their effective rate way up to nearly 20% to cool down the overheating economy. Higher short-term rates meant higher yields on cash, and soon the yield spread inverted. By December of 1980, yields on a 3-month T-bill boasted a 6% yield premium over stocks. In just 6 months, the risk-reward ratio flipped, and cash assets like bonds became a much more attractive investment than stocks. The stock market entered a prolonged bear market, falling 27% from the end of 1980 until mid-1982. More or less the same story that played out in most of these other instances. Historically, once cash returns trumped stock returns, the market has usually contracted soon after. But notice how stock yields remained well above cash yields throughout this entire period between 2001 and 2022, with stock yields particularly high between 2010 and 2020. The big reason for that is interest rates. After the 2008 financial crisis, the Fed flattened rates to near zero in order to stimulate economic growth, and they kept them that low for almost a decade. So for that entire time, cash paid investors almost nothing. Meanwhile, the S&P 500's earnings yield was much higher. At the peak in 2012, stock yields were more than 7% higher than cash yields, which contributed to a remarkable stock market rally from 2009 to 2022. But that entire landscape has changed. Starting in 2022, the Federal Reserve launched an aggressive rate hiking cycle to fight runaway inflation after the pandemic. This pushed short-term rates from 0 to over 5% and dramatically increased the yield on cash. By July of 2024, 3-month T-bills had a 2% yield advantage over the S&P 500. But since 2020, we've only seen 3 sizable market downturns. The longest and most pronounced was the 2022 bear market, which started and ended before the yield spread had inverted, so it preceded the signal. The other two, in mid-2023 and early 2025, were both short-lived corrections which quickly turned around into rallies. We haven't seen the kind of deep, prolonged contraction that followed most of the historical scenarios in which cash yields were higher than stock yields.